All right, Chris, go for it.
Hello, everybody. Thank you for joining. We have a wonderful presentation set up for you this evening. You have our CEO, Vikram Raya, who many of you know. For those of you who don't know who I am, I'm Chris Parinello, the Director of Investor Relations for Viking Capital. We have a really special guest today, John Chang, from Marcus Millichap. He's a Senior VP and really their head of research. We're going to be talking about a range of topics today. We have some questions that were sent in by some investors. So we're really excited to share this information with you and get you all some extra education when it comes to multifamily.
Awesome. All right, guys, welcome to the conversation here. Before we get started, put in the chat box below. I just want to make sure everything's working. Where you guys are from, so it'll give John a perspective across the nation of some of the attendees. Awesome. Ashley's from Charlotte. We got New Jersey, got Ohio, Katy, Texas, New York, West Palm. So John, they're coming from all over for you, man.
Yeah, right. Geez, they're really all over the place. That's
great.
We
got Hawaii, Vegas,
Chicago. Wow.
Connecticut.
Okay. Awesome, guys. Awesome. So here at Viking Capital, our goal is to create the intelligent investor, the sophisticated investor, and the informed investor. And I don't care if you invest with Viking or any other group out there, or you do your own investments, but having knowledge and acting on that knowledge is true power. And so that's why we're bringing some of the best people in the country, some of the leaders of different industries, the top economists, to share with you the cutting edge knowledge based on data and intelligence, so you guys can make informed, powerful decisions for you and your family to create wealth. And so with that said, let's get into it. Today's topic is called Turning Economic Uncertainty to Unfair Advantage. And why I say that is most people right now are sitting on the sidelines. There's a lot of quote unquote dry powder. There's a lot of equity. There's a lot of people who are not sure what to do. And by you understanding trends, data, statistics, and sort of where the country's going, where the economy's going, where interest rates are going, you'll be able to act quickly because there's a first mover advantage sometimes. And so with that said, let's get into it. We're going to ask John. And again, John is one of the top economists in the country. He's one of the experts in multifamily. He's been doing this for 30 plus years. I've seen him at some of the most elite conferences, meetings, and discussion points. And he has a powerful thought leadership platform as well. But he's going to share with us his knowledge today on, what comes next with interest rates. Will there be a soft landing? What is really driving housing and multifamily markets right now? And how can we build more wealth with multifamily? So with that said, a little bit of my background. My background is in cardiology. I was a physician, practiced for many years, loved it. And as I fell in love with real estate, sort of transitioned into sort of my second career, if you will. And my buddy and partner, Ravi Gupta, we founded Viking Capital in 2015, not only to help grow our own assets, but to help other friends, family, colleagues, and eventually other high income earners all over the country really have a unfair advantage in real estate outside of Wall Street. And we now are at about, I think, close to 720, maybe $750 million of assets. We've raised over $250 million of private equity. We've acquired 25 deals all over the country. And we're really excited to bring experts such as John Chang here. And again, here's a little bit of his bio, but really what I love about John is he takes all this data, the research that his extensive team at Marcus Millichap do, and he brings it and distills it down to where the individual investor can understand it and take advantage of that knowledge. And so you'll see him featured, on major network channels. He has a YouTube channel that's very popular. He has, he's also on the Marcus Millichap platform. So please subscribe to his research, and his the multifamily reports, and all the other reports he pulls out are really impressive. And so with that said, John, I'd love to get you going here. And let me see if I can get this next slide going. People want to know, will there be a soft landing, my friend?
Well, thank you for the fantastic introduction, Vic. That was amazing, and I feel honored to be here with these investors. You're right. You're spot on. There's so many advantages to what's happening in commercial real estate. And there are advantages to taking action when so many are on the sidelines. Right now, just so many investors that I'm talking to are taking a wait and see approach, especially at the institutional level, and they're really being exceptionally cautious. And as a part of that, they're opening up our opportunities for other investors who are able to get down into the nitty gritty a lot more quickly than some of those institutional investors can. So the question is, will we have a soft landing? And we're seeing so many indicators that are looking positive. If you rewind the clock to a year ago, right after the Jackson Hole meeting, where Chairman Powell came out and said, hey, there will be pain, right? He was talking about what's happening with inflation, what's happening with interest rates, and how high they were going. They really scared people, and it created a much more pessimistic outlook on what to expect in the economy this year. And so in this chart, you can kind of see in that 2023 outlook that in October of last year, the forecast for economic growth this year was just 0.2%, and almost everybody was saying there would be a recession. Then as you got into January, it raised up to 0.5% growth forecast for the year. Then in May, it had gone up to 1.1. And as of September, our most recent consensus forecast out of the blue chip economists, the best economists in the country, they're now saying growth in 2023 will be 2.1%. Now, we're almost 3/4 of the way through the year anyway, so we know it's probably not going to be a recession this year. A lot of people are questioning whether there will be a recession in 2024. Goldman Sachs just came out and said they're reducing their probability of a recession in the next 12 months down to just 15%. The consensus forecast for economic growth in 2024 is about 1%. So it's still soft, but not a recession. And that's the key. What the Fed is trying to do is trying to slow things down without dropping into a negative growth scenario where we start to lose jobs. And that's the next slide here, what we've seen with jobs and where we see that going. Again, it's the same positive trend where, a year ago, we were averaging about 430,000 jobs per month. 6 months ago, we were averaging around 250,000 jobs per month. And now we're averaging about 150,000. That's still very good. We've already added 1.9 million jobs in 2023. We're seeing that pace of growth slow down, but we're also seeing the number of job openings come down as well. So we're seeing that labor shortage shrink. A year ago, there were 6 million more jobs available than there were people looking for work, than the number of unemployed people in the country. There was about 12 million job openings this time about a year ago. And now we're down to just a spread of about 2.4 million. There's 8.8 million job openings right now, 6.4 million people looking for work. So that spread, that gap, that labor shortage is shrinking, and that is another positive trend. What that will do is reduce the bid war for labor and start to bring down that wage growth and help the investors, help the economy start to slow down and even out as we go forward. And then on the next slide, I want to highlight that the unemployment rate is just 3.8%. It was hovering right around 3.5 for many months. It ticked up a little bit. Corporate profits are near a record high, but they've flattened out. Inflation adjusted core retail sales, which throws out fuel and autos and groceries, but on an inflation adjusted basis, retail sales are still climbing, but just at 1% now. You can see again that curve flattening out. And then the total savings in the US in the bottom right there is almost back in alignment with where that trend would have been. We had a huge burst in savings as we went through the pandemic. We had all the stimulus come into the economy, and that was part of what caused the inflationary pressure to begin with. It gave a big shot in the arm to the economy. We had explosive growth. But we're coming to the backside of that, And if you look at that dashed line there, we're back into alignment with where we should be with savings. And that means that we're going to see the economy stabilize a little bit more, and that growth rate should start to flatten out. So these are all of the signs that you would be looking for in a soft landing, which is truly a rare event. We've actually never had one before. It almost always goes into a recession afterwards. So all things considered, we're looking really good in terms of where the economy is sitting right now and with our forward-looking forecasts.
That's amazing. That's a lot of different angles to look at this economy and for the soft landing. Chris, I know you've been surveying a lot of our investors all over the country, people who've been investing with us for years. They may have some questions. Is there a economic question maybe you want to pose to John that can represent maybe some of the investor curiosity?
Absolutely, John. This is really great data. It's incredibly comforting to be able to see all these different angles and really see why a soft landing is, one of the outcomes. I think what a lot of folks are wondering is what should they be looking for? A lot of these folks are following the news, they're watching, your reports, things like that. What kind of trends should they be looking for that would indicate that something's changed, that maybe a soft landing isn't as likely without somebody come out and saying it?
Yeah, you got to be careful with the news and media. One of the things, I shoot a video each week, and one of the things I spend a lot of time doing is kind of debunking the story that's being told on the mainstream news media. The reason being that a lot of the times they're focusing in on something that's very negative because that's what draws eyeballs, that's what gets people's attention. So as you watch the news media, and of course it's important to stay informed, but the key things I'm focusing in on right now are confidence levels. Now we've seen consumer sentiment has dropped like a rock last year, and then it's come back up, and it's teetering right now. So that's one of the key things I'm watching. I would always watch the unemployment rate and the job formation numbers. Those come out on the first Friday of every month. And those are key indicators. And then I would also watch what's happening with core retail sales. That inflation adjusted core retail sales is going to be a key figure going forward, because 70%, roughly 70% of our economy is driven by consumption, and a big piece of that is the core retail sales there. So as you look forward, as long as that retail sales number is positive, and as long as sentiment is staying positive and moving up, even if it's just a little bit, those are going to be key attributes to monitor. This could always be thrown off, right? We just had a hurricane go through Florida. Hurricanes can be very disruptive. And so you kind of have to watch. There could be a variety of challenges that show up over the course of the next 6 to 9 months that we're not anticipating. And those black swans are things that you're going to want to keep an eye open for. But generally speaking, most of the indicators are pointed the right direction.
Guys, so if you just caught what John said, just keep monitoring, really transparent data where it's talking about consumer sentiment, and really following that trend. And obviously outside of a black swan event, the data seems to be showing a soft landing. So that being said, I know Jerome Powell and his colleagues met recently, and some of the intonation is there's another interest rate hike, perhaps it's a pause, it's a reflection. So I wanted to ask you, John, where do you think interest rates are going, and what comes next, and what's sort of driving the behavior of the Fed right now?
Sure. So the key thing here is inflation, right? They're responding to what's happened with inflation, and you got to remember the Federal Reserve was stimulating the economy up until March of last year. I mean, they were really caught flat-footed. They kept saying it was transitory and it was going to be fine, it'll go away, and it wasn't. So interest rates were going up, and inflation was going up, and the Fed really responded to that. They hit it really hard last year. Inflation peaked. CPI, and there's many different ways to measure inflation, but CPI peaked out in June of last year at about 9%. Since then, it's come back down to 3.2 as of the last reading. and there's a variety of other indicators. For example, PPI on this graph, the producer price index, which is bouncing off of 0. That was at 12% in March of last year. That's a forward-looking indicator. In March of last year, it hit a peak and it's come down dramatically. So basically, what this is saying is inflation got high. The Fed reacted late, but they hit it really hard. And now we're seeing those inflation drivers come back down. They're not where the Fed wants them to be. The Fed is going to be tracking core PCE, personal consumption expenditures. That's right now is in about the 4.2% range. It's trickling lower. We do expect it to turn down a little bit more quickly because it tends to follow the other indicators. And we expect that to continue to fall. The Federal Reserve wants that at 2%. That's going to take another year or maybe a year and a half before they get it down to 2% if everything goes well. It just doesn't move that fast. So it's going to take time. But the Fed has been pushing up those rates all the way up until this year. Now, we had a rate increase earlier this year, and then they held, and then they had another rate increase, and then they've held it at the last meeting. But the thing is as you look forward, what does Wall Street say? Wall Street's saying 93% chance that they're not going to raise rates in September. And that's based on a lot of indicators that the market's looking at and how the bets are being placed on different bonds. And then it's just over a 50% chance that they're going to stay flat in November and December. So right now, the bet is that there will be no rate increase in September and kind of 50-50 odds for the rest of the year. If we see another rate increase, it will be just a singular movement. I personally don't think they're going to need to move them again. If you look at the language Powell's using, he said, that they believe the current rate is sufficiently restrictive to continue to push down inflation. So we do expect that this is going to be stabilizing through the remainder of this year and into 2024. Now, at that point, they could possibly lower rates a little bit just to take some of that restriction off, but they probably won't do that until the latter part of 2024 and only if they get inflation down further. So right now, everybody keeps talking about how high rates are. And really what we've seen is a huge shock to the system. We've seen the rates go up really fast, but actually, they're not that high. If you look at the long-term average for the 10-year Treasury, going back to 1955, the long-term average is 5.6%. And today, the 10-year Treasury is at about 4.25%. The long-term average of the federal funds rate is 4.6%. Right now, we're at 5.25 or so. And so we do expect that overnight rate will come down a little bit sometime in 2024. But that 10-year Treasury is probably going to be pretty sticky in that 4.25% to 4.5% range over the course of the next year, which implies the cost of capital for investing in real estate should be stable from here going forward through much of 2024.
So guys, that was an important point, the cost of capital being stable, because that's really what will spur transactional volume. And you'll notice there'll be a lot more deals and transactions that'll start to resume. So that being said, Chris, what do you think would some of the investors ask about sort of the interest rates and maybe inflation?
Yeah, I think that really answers a lot of them. I mean, really, I think what investors are looking for is they're trying to figure out what's that equilibrium. Where does it make sense to where private equity firms like Viking or other even institutional groups, what's going to increase the motivation to where they feel like this is how it's going to be and this is where we can transact and where we're going to get great value. I think that's really what people are wondering. Is it here? Is it in the beginning of 2024? Like what would you think, John?
Well, I think that actually right now is about as good a time as you're going to get. And the reason is as I mentioned earlier, a lot of the institutional capital is out of the market. So if you're looking at transactions, say north of $20 million, if you're looking at larger properties, a lot of the competition for those assets is not in the marketplace. The market is still going through the process of identifying where the true values are. We're still seeing these cap rates move. We're still seeing a lot of opinions of value come in. A lot of people are trying to figure out where the market is. The sellers have been reluctant, of course, to reduce their prices and raise the cap rates on what they're selling. But they're starting to get to the point where they're coming to terms with the current market. It was so hard last year when the interest rates were moving so fast. You couldn't underwrite a deal because your cost of capital was changing every month. And it was really just moving too fast. It was hard to do a deal last year. Now, if we stabilize these interest rates, which I believe we are, then you're going to be able to sit down and do the math and come up with an answer. Some people may like the answer, some people may not, but it is going to be, it's more stable in terms of what you can see. And then the other question is, you know, you can go get a 6-month treasury. You can go get a 6-month treasury at 5.5% yield. And so why put your money into real estate instead of just buying a treasury? And that's all about the future of the property types. And it's about the opportunity of value creation. And it's about long-term demand drivers, which is kind of where we're going next.
Yeah, absolutely. And speaking of demand drivers, so let's talk about it. You know, in the green room, John, me and you were sort of talking about office, retail, apartments, and just sort of seeing, you know, what's on the horizon here. So since we are multifamily specialists and really we've really built our portfolio on this, can you sort of share with us what is driving apartment demand? And you know, are we supposed to be seeing a drop off in demand because of housing, or is there going to be a spike in demand because of housing? Or, you know, is there less interest in this asset type? And so maybe we can share some of that data points.
Yeah. In fact, this slide, actually, the slide you just pulled up is perfect. What this is basically each of those bars is how many people there are in the United States who are that age. So if you look at the peak of the blue bars there, right at what, 31, 32, 33 years old, that is 4.6, 4.7 million people are that age in the United States. And that is a sweet spot for household formation, right? You look at marriage is actually now about 30 years old. And that's been getting older and older. People have their first home purchase. Now that's in the 36-year-old range. It used to be 32. Now it's 36. But that sweet spot right in that big bump in those blue lines is prime housing demand creation. That's where people move out on their own. They go out, they get their own place, whether it's an apartment or they go buy a house, whatever it is. Now, between 20 and 34-year-olds, that pie chart up there, 63% of them live in a rental household. And then by the time they get into their late 30s, early 40s, that drops down to about 40%, with the other 60% living in some sort of owned housing. So we just have this huge wave of millennials who are still in the sweet spot for household formation and housing demand. That's what's been pushing the housing market for the last few years, actually the last 5 or 6 years, and it is still going to be a tailwind. Based on our most recent calculations, we still have a housing shortfall of between 3 and 4 million housing units that is just not going to be fulfilled. The construction, even though multifamily construction has been going at an aggressive pace over the last year, is still not keeping up with demand. Single family construction has not been keeping up with demand. And so even though we've had a little bit of a soft patch here as we've gone through some uncertainty and household formation slowed down last year, we still believe that ultimately over the next several years, housing demand will remain very strong, and it will favor rental housing over the next several years. And there's a variety of reasons for that. If we go to the next slide, this one right here, it talks about young adults living with their parents. We saw a spike in that during COVID. People moved in with family. and we saw a big spike in young adults moving in with family members. It's come back down over the last 2 years, but it is still way above normal. So we see about 3 million young adults who are still living with family above normal. And those households started forming, they started bundling following the financial crisis, and we expect that to debundle over the next 5 years or so. Excuse me. So that brings us to the next piece, which is what's happening with single family housing. The home prices have shot through the roof. We saw that over the last couple of years. Not only that, it's been amplified by rising interest rates. So the cost differential between the house payment on a median priced home and the average rent in the United States has opened up to the widest point we've seen. It's over $1,100 differential between the average rent and the payment, monthly payment on a median priced home today. And so home purchasing has become very unaffordable over the course of the last 2 years. And as a result, we're seeing a lot more demand for rentals, and we're going to continue to see that. We are not forecasting a decline in single family home values. We saw a little drop after it peaked out when the interest rates are rising. We've already seen that trough already, and we're starting to see the prices start to climb up again. So it's still just light of 400,000 per house for a median home price, but it is on the uprise. And as a result, we just don't see the demand is going to be falling off. And the construction of new homes is still falling behind what we need to see those prices come down. So the only relief will be in an interest rate reduction, which we really don't see that coming either. We just don't see that differential between renting and owning shrinking very much in the next year. And even though rents have gone up quite a bit in the last couple of years, they haven't gone up anywhere near what a home payment has.
So that affordability gap, that's pretty wide, almost $1,200. And do you see that persisting, or do you see that will the rent start going back up in terms of to try to eclipse some of that gap, or will home monthly payments come down as interest rates improve?
Well, so I think interest rates flatten out. We may see them shrink down a little bit, and that'll be mostly by lender compression. Basically, the lender spreads will compress a little bit. But at the end of the day, the interest rate, the mortgage rates are based off the 10-year treasury, and we see that as holding pretty firm in that 4.25% range. So the mortgage rates may come down a little bit, but not very much. We don't expect the home prices to fall anytime soon, and rents will climb, but they're not climbing at 15 or 16% like they did right as we were coming out of the pandemic. We're expecting 3, 4, 5% rent growth. So yes, that spread will narrow a little bit each year or over the course of the next year, but it won't be significant. If you look back to 2007 when that spread, or 2006 when that spread was at its peak, before, it was only at $779. So it's much wider today. It shrunk as we went through the post-financial crisis cycle, and home prices fell pretty dramatically. But again, we're not expecting home prices to drop substantively, and rents will continue to climb, although not at a huge rate, single-digit rent growth. And so that spread is going to keep more people in apartments over the next, 5 years or so.
So it's affordable. The demographics also support it, and then the fact that home prices are going to stay elevated, as well as mortgage rates. So the key really is and there's a shortage you mentioned with only 3 or 4 million units shortage across the country for housing units still. So all these things are really factoring into apartment demand.
Yeah. Oh, go ahead, Chris.
I think that, that is really going to speak to our investor base too, because when we're going through a lot of these deals, even when inflation was high and we were seeing 10, 12, 13% rent growth organically, we didn't build that into our deals. So now I think what people are worried about, and what I get asked all the time is 3% even realistic? Is 3, 4%, is that realistic? Are we going to see negative rent growth because of how high things peaked. And I think, the data that you're showing is showing that 3% is still realistic. And that's something that I think is going to comfort a lot of folks when they're looking at where to place their capital and where they're going to, preserve their wealth.
Now you're going to have to drill down, right? It's going to be market driven and it's going to be asset driven, right? So you can have a property that can still generate 10% rent growth because you're doing it through value add, or you are in a market that's going to have a new employer coming in, or there's something driving people to come live in that market. And so you have a lot of population coming in and just not enough development. Conversely, you could have a market where you're going to have negative rent growth or falling rents because you're losing population, or there's a huge wave of overdevelopment and you create a short-term oversupply cycle in a local market. So this is where you kind of have to step away. You look at the big numbers, you say, okay, in general, everything's moving the right direction, which it is. But there's still the local market expertise is very important. Knowing the market, knowing the dynamics, knowing the drivers of that area, and doing your diligence is key. Because if you nail this, you can still generate really, really strong returns. And this gets back to my point about are you investing in a 6-month treasury at 5.5%, or am I getting a 5.5% yield on a piece of real estate? The real estate has more upside, right? That treasury comes, you get 5.5% for 6 months, and then you're done, and you go reinvest, or you do whatever you want. But the real estate actually continues to grow in value over time, and it compounds, and you get leverage. So there's a lot of advantages there, but that local market expertise will be key.
So let's have a shift here and let's focus on the actual apartment performance. John, can you get into that a little bit?
Sure. So here you can see, where that orange line, that orange bar drops below the baseline there, it goes down into the negative range. Those are periods where there is negative absorption, right? And so you had it back in 2002, and you have it in 2022, and those are periods where you have uncertainty in the market, right? So last year we had a fall in sentiment. That was because we were seeing massive inflation and the Fed was raising rates like crazy and scared the crap out of everybody, pardon my language, but they really, really created a fear market where people were afraid to go out and form a new household. And so that's why you see that absorption of apartment units fell negative, and we saw a big spike in vacancy rates. At the same time, we're going through a period of rapid completions. We're seeing about 400,000 new units completed in 2023, which is a record, the most we've seen since the 1980s. Now, ironically, the reason there are so many housing units being built is because the millennial generation is coming of age and forming households. So that's a real positive. The last time we had growth like this was in the 80s, when the baby boom generation was going through a similar cycle. So we expected this to happen. This is all right on point. And we expect to see that supply and demand move closer into balance in 23 and actually get even more synced up in 2024. And that will flatten out that vacancy rate going forward into 2024 and beyond. When you look at what's happening in the vacancies by class, you have the, during the pandemic, your Class A vacancy shot way above everybody else. Your Class B, your Class C, but now it's starting to normalize, and everybody, and whether it's Class A, Class B, Class C, it's all kind of normalizing into that 5% range of vacancy rate. It's trending up. This is mostly being driven by that slowdown in absorption from last year, together with that rise in completions. And as a result, we've gotten into, a slower pace of rent growth, just north of 3%. Now, that looks like it's way down, because it is compared to the prior year where we had double-digit rent growth. But double-digit rent growth is abnormal, right? That 3 to 5% rent growth is normal, and that's what we're moving back into. And in fact, when you look at vacancy rates, 5% vacancy rate is normal for apartments, and we're moving back into that range. So essentially, we're moving from an abnormal situation in the post-pandemic cycle into a more normal cycle for apartment demand and apartment rent growth. So things are actually getting back to what we would expect them to be on a normal basis. But as we look forward, this is probably the most important piece of this, is that the pace of construction has been slowing down. If you look at the number of units started in each quarter, it peaked out in the second quarter of 2022. That's when interest rates were really starting to push upward. The cost of construction capital, loans for construction, have shot upwards. The cost of materials has gone upwards. The cost of labor has gone upwards. It's made it much more difficult to build apartment units. And as a result, we've seen the number of starts drop down from 150, 160, 180,000 down to about 40,000. So looking forward, that supply risk is diminishing. At the same time, we expect the demand drivers to increase. And that is a combination that will drive vacancies back down, and that will support increased rent growth as we go forward.
So, as we start exploring opportunities in the country, John, we at Viking love the value add space, the garden style multifamily apartments. In fact, we built our whole portfolio on it. But as we explore, we're looking into A-class properties, we're exploring development, and I'll get your opinion on development maybe near the end. But one type of asset class within the multifamily space is this life centers. And I really like this concept, this mixed use retail multifamily for these town centers. Here's an example of one that we're exploring right now. And it's really impressive because it's a unique competition asset, meaning there's only one apartment complex in there. So they sort of have a monopoly on this kind of space. And so I want you to maybe speak about possibly retail and multifamily in this mixed use space. And is retail coming back? Where does the data show, John?
Well, these lifestyle centers are doing very well. It's basically taking that old neighborhood or that small downtown and style and creating it again with a set of apartments with some retail and maybe a little bit of office space there. They've done very well. When you look at the retail side of the equation, it's doing very well. In fact, arguably, retail is seeing its best performance in the last 15 years. It really got disrupted by the financial crisis. It had a huge disruption because of e-commerce. And it really took time to find its footing, but we've seen the vacancies come way down. We're basically on par with record low vacancy rates, right around 5%. And we're seeing rent growth in the 3% range. There is no real construction in the retail space. So your supply risk is very low. Your demand drivers are positive. If we look at the next slide, we have kind of a breakout, but basically we have more stores opening today than we're seeing closings, right? And that doesn't happen actually very often. And so we're seeing a revival of retail. We've seen pure play retailers, internet retailers like Warby Parker and several others decide that they have to have brick and mortar space. It's better for their brand. It's better for their ability to connect with customers. It's better for them to handle their e-commerce business with fulfillment as well as returns. And at the same time, we're seeing a lot of traditional retailers expand into the internet, but also expand their footprint. Now, again, with the headlines, you always hear about store closings, Bed Bath & Beyond, some upcoming closings for CVS and some of the other pharmacies and so on. But what you don't hear about as often is how many are opening. And right now we're seeing a lot more store openings than closings. And quite frankly, when I do talk to the retailers, because I'm in the ICSC retail research group, and I talk to the research personnel at a lot of these major retailers, they're saying their biggest challenge is finding space to put their new stores. So retail's looking fantastic. And in conjunction with multifamily, with these new lifestyle centers, they can do very, very well.
So let's talk about transactional activity. When is it planning to revive? What do you see in your crystal ball, John?
Yeah, so sales are way down, right? You compare it to last year, which was the peak year, by the way. It was far beyond anything we'd ever seen. Sales are down about 50%. They're cut in half. But, that's really actually not that bad when you compare it. Historically, we're somewhere in that 2014, 2015 velocity range or similar to what we saw in 2005. So we're seeing some good, so we're seeing a pretty significant downturn in activity. But now that people can get their underwriting done, now that the rates are stabilizing, I think the deal volume will start to catch up. I know there is a tremendous volume of dry powder on the sidelines. There is a lot of institutional capital waiting to be placed, and all of that will start to play through. We should see a little bounce in the fourth quarter. As people start to get active, we're seeing a lot more opinions of value and buyers who are coming in and signing confidentiality agreements. So we're starting to see the momentum pick up. That will manifest into sales going into the fourth quarter and carrying into 2024, and we should be on a steady upswing as we go forward. Next slide. We do have a fair amount of properties that are going to be facing loan maturities. And as these properties have a loan mature, that investor is going to have to make a decision. Do they sell? Do they refinance? Or do they come up with something else? Or do they pay cash and buy it out? Generally speaking, people would normally refinance a lot of the time, but the interest rates are dramatically higher. So a lot more are going to consider selling. So we do see a bump in 23 and 24 and 25, where we may see a lot more activity of properties coming to market. Now, remember, if they have a loan coming due in 2024, that means they probably bought it in 2019 or maybe even 2017, and there is a lot of equity on that property. And so even though that price may not be as high as it was at the peak of the market in 2021 or 22, they still are doing very, very well. So they will not be afraid to sell that property and take a really good profit on it. So we see this picking up in 2024 and 2025 as we go forward, as those loans mature. And then as we look into the cap rates on the next slide, we can see that they're recalibrating. Now, the problem with cap rates and the problem with the numbers you see on this graph is that they're backward looking, right? So if something closed and we captured that information and it closed in say the second quarter of this year, that deal was put under contract, 6 months before that or 3 months before that. And so as we look forward, as we look at what our brokers are telling us about where the market is, we're seeing a correction from the low point of the cap rates to where they are today of between 50 to 200 basis points above what they were at the peak of the market in 2021, 2022. And that will depend on, again, the market and the outlook and how tight those cap rates were. We were seeing cap rates as low as 3% at the height of the market. Those are the markets that are going to recalibrate maybe 200 basis points. They may be trading at a 5 cap now. Whereas something that was in a secondary or tertiary market, in a smaller market, in an outlying area, may have gone from, say, a 5 cap to maybe a 5.5 today, and not as big of a movement. So a lot of variance there, but again, it should start to normalize, and we're going to see some opportunity there. The question will be when the wave of capital comes back in and flattens those cap rates back out again. And that's going to be the big timing issue that we're going to be looking at going forward.
Awesome. That was such an amazing overview of so many different data points, so many different trends. So, John, I want to thank you. And then if we have a little bit of time, we may ask 1 or 2 more questions.
Sure.
Especially, I think there may be a very interesting question about we're getting from investors about the elections. But I just want to take 1 or 2 slides, share some more information with our audience, and then we'll wrap up in a second. So, guys, why, our investment thesis is why does renting remain very stable? And we've talked about it already on this presentation, but you can see the affordability gap between the cost of owning a single family home versus renting. And so that is obviously prevalent and will persist throughout. And so that is predicated on our investment thesis is predicated on that concept. On top of that, there's, the average rentership in the United States, and then the orange line is Viking Capital's median rents. And so even compared to the US average, we're on top of that. And I really think it's due to our stewardship of these assets, selection, right market, right geography, right asset at the right basis. And as we move forward, this is sort of what we perceive as why there will be headroom for us to do rents. And we're not pushing rents willy-nilly. We are doing a strategic value add. So we're adding value, infusing CapEx dollars into these assets, making it desirable for the millennials, for the baby boomers. And that is really where rentership is going. And the U.S. is experiencing its lowest homeownership since 1995. So that is a trend to pay attention to. And we've seen rent growth nationwide, especially as single family homes become really unaffordable. And so for you guys, I think my message here is really take advantage of the opportunities, whether you're an active investor, and you're getting into this yourself, you're a passive investor and you're working with groups or large institutions, but on top of traditional portfolio investments, really growing this passive investment basket is really powerful because it is a stable investment. There's consistent cash flow. There's obviously tax advantages, and obviously the forced appreciation really does increase the value. So it is a conservative way to really grow, I think, your portfolio and your wealth. And as an example of some of the things we do, there's an opportunity here called Park 33. It's a deal we found in Indiana, in South Bend near Notre Dame, and it was A-class asset, Core Plus 2018, 3% interest rate. We're assuming 98% occupied, gorgeous property. And we got it at a 6 cap, which is unheard of for this type of asset grade. And I think it's because there's opportunities now in the market if you're looking. And if you're like, we underwrite probably 1,500 to 2,000 deals to find 5 to 6 that work. But unfortunately, this one's already fully funded, guys. So in the future, if you want to get into these kind of investments, love for you to join us. Love for you to book a call, vikingcapitalinvestments.com. That's the URL. There's a link, I'm sure, somewhere. Our team's going to put in the chat box, and you'll probably get on the replay. So I would love for you to chat with our team, not necessarily about this investment, but just about your philosophy, what you're looking to do with your portfolio, what your time horizon is for any capital events, and your goals for really passive investing. And with that said, I think that we're at the end. So now, John, I get to tease everybody here, and I'm going to stop sharing here. Let's talk about what's going to happen with this election. And I know if some people have to go, that's great. You'll get the replay, but we're gonna drop some really juicy tidbits here. And by the way, guys, follow John on his YouTube, follow on Marcus Millichap website. He's also on LinkedIn. Anywhere else, John? I'm sure you're everywhere else, but
LinkedIn is probably the best one to catch the videos.
Okay, LinkedIn. There it is, guys. But help tease us a little bit on what you think is going to happen with the election.
Well, who can say who's going to even be on the ballot, right? But, one of the big questions that people have been asking is about what's happening with interest rates. And one of the big ideas people believe is that interest rates are going to be lowered because of the election. So there's a lot of people who think that we're going to drop interest rates in 2024 as we go into the election cycle. So actually, I just shot a video about this. It will be posted next Monday on my LinkedIn channel. And we went in and we took apart all the data and we said, okay, what happens in election years? And we said, okay, so out of the last, I think it was 17 elections, basically half the time interest rates went up and half the time they went down. So there was really no correlation there. We said, well, what if it was a Republican president? Was there any difference? Or if it was a Democrat president, was there any difference? And really there wasn't. So basically, in a nutshell, from an interest rate standpoint, I would not expect the Federal Reserve to do anything differently over the course of 2024 based on there being an election. The decisions will really be driven by what's happening with inflation and what's happening with the economy as a whole. So if we go into a recession, they'll drop rates. But if we're not in a recession, which is what we're all hoping for, then we should see rates hold pretty stable over the course of 2024.
That's amazing. Thank you so much. That would have fooled me, because I would have thought, usually election year, the rates will drop in to favor the incumbent and things like that. But that's why data is much more important for decision making, guys, especially in real estate. So great. Chris, do we have time for a couple more questions, or should we let people go here?
Being told to wrap up. I'm looking.
Okay.
It looks like most of the questions were answered in the presentation.
Okay. Awesome. Guys, thank you so much for attending. Catch the replay. Follow John on LinkedIn. And really appreciate you guys, tuning in here and up-leveling your investment education. So until next time, guys, cheers.
Thank you.
Thank you, John.